What's going on, everyone? Welcome to another episode of the Remote Real Estate Investor. I'm Michael Albaum, and today with me I have Pete Neubig, who is a real estate investor and CEO of VPM Solutions. And Pete's going to be talking to us today about some of the mistakes that he made as an investor and how he's doing things a little bit differently today than maybe your typical investor. So let's get into it. Pete, what's going on, man? Thanks so much for hanging out with me today. I appreciate you coming on.
Michael, thanks so much for having me. I'm really looking forward to it.
No, me too. And so before we hit record here, you were telling us about the three different lives that you've lived. So you are a super interesting guy, needless to say. So for anyone who hasn't heard of Pete Neubig before, give them the quick and dirty rundown, who you are, where you come from, and what is it you're doing in real estate today?
Sure. Well, real quick, let's see. I'm from New York City originally. I moved to Texas and Houston back in 1995. So I have a gun, so I guess I'm a Texan now.
Don't they give you one when you move to the state? Like, welcome to the state, here's a gun.
I think they give you a cowboy hat, a gun, and some boots, you know? So I started buying real estate in 2001 when I bought my first property. Actually, I bought a duplex and a 100 unit apartment complex like same day. Like I closed on the same day. I ended up owning a bunch of property that I ended up starting a property management firm. And I got so busy doing that I stopped buying real estate for a while just to build the property management business. I ended up selling the property management business, and now I started an online platform. It's a virtual property management solutions, or VPM solutions, where we connect the real estate industry with virtual talent around the globe. So that's it in a nutshell.
Cool. Pete, just taking a total step back to you say you're from New York and now living in Texas. Do you remember, like, I don't know, in the late 90s, early 2000s, there was that Pace salsa commercial where like all the cowboys were sitting around. They're like, where's that guy from? New York City. New York City.
New York City. I sure do.
When you said that, that's like the first thing that I thought of, like, oh, Pace salsa commercial.
Man, I still can't say y'all correctly. I get yelled at all the time when I'm down here saying y'all. So
y'all with a New York accent. I love it. I love it. Well, Pete, I mean, this is a really cool trajectory that you've ended up on. And I would love to focus on kind of the first stage of your investing career where you owned a bunch of rentals. And again, we were chatting before we hit the record button, and you were saying that you had sold a bunch of them off and then actually paid off some of the remaining ones. So walk us through, like, why? Because I think a lot of people will be like, oh, that's stupid. Like, what is Pete doing? You got to have leverage. That's how you juice your return. So, walk us through how you built up the portfolio and then why you decided to sell them, but then keep some free and clear.
Sure thing. So I started buying on my own first, right? So I owned like 12, I think it was like duplexes. For some reason, I just love duplexes. I think most people would say, well, it's the cash flow, right? Mm-hmm. Duplexes have a great cash flow. And I was always looking at just cash flow. And if I go back in my investor life, I can tell you, Michael, I've lost so many millions of dollars by not buying houses with very low cash flow because I forgot about this thing called appreciation. Right. And I was just buying cash flow. Right. And my goal at the time, I was a young man. I was early 30s, like 30, 31 when I started buying. My goal was to get enough cash flow so I can just leave my corporate job. That's kind of the way I was thinking. So I buy a bunch of properties. And then I get talked into being a passive investor for a 100 unit apartment complex. And I told if I buy one apartment complex, I can retire. Right. So I'm like, oh, great. Monopoly. I'll buy a bunch of houses, sell them and all that good stuff. Well, it never materialized. I was buying lower income homes. And if anybody knows the lower income homes, the cash flow is really just on the sheet of paper. It's not true returns, unfortunately, because there's little things like, the evictions or you're not getting all the rent. And then the make readies are not a couple $100, they're a couple of $1,000 because people in low income, they take what's called parting gifts. They take your AC, your doors, your sheetrock.
Well, goodie bags,
Yeah, goodie. Yeah, exactly. So I ended up connecting with a business partner named Steve Rosenberg, who he's kind of a national speaker now. But Steve and I ended up finding this guy who was offloading a lot of his portfolio. So we thought this is great, and we ended up buying like 30 houses, and we were both enamored with buying property, but we had no idea what to do once we bought them. Like we were terrible on how to manage them. So what happened was,
and Pete, was this local in New York or local in Texas, or was this remote?
Yeah, great question. So I had lived in Texas at the time. We're buying everything in Houston.
Okay.
There was no such thing as roof stock that we knew of to go buy stuff in other areas. And back in the early 2000s, the average price of a single family home in Houston was like around 130. I was buying it for 35,000. Like low income houses. Yeah, I
What
was
are they?
buying
Do
stuff
they
for
not have
35.
roofs? Like, what's the deal?
Man, they were just in low income, and today those houses are now worth about 150, right? 20 years later. And I was buying them
Wow.
at 35 and they were worth 50 to 55,000. So I was buying them below, but I just found an investor who wanted to offload stuff, but he was offloading me all his problems, right? And if you don't have good management behind you, even if you have a good management company, by the way, it's really difficult to manage this low income stuff. It just is because they don't pay online, they don't abide by the lease, they have dogs when they say they're not going to have dogs. All the stuff that you have to deal with is just difficult. And so Steve and I, we ended up buying 31 homes. So now I have 31 homes and we advertise bad credit okay, no credit okay. Like you have a pulse and a dollar, we're gonna let you in the house. And of course that comes back to bite you to the point where not only are we not making the cash flow that was projected, but we're losing money. At the end of the year, now I have to come in and pay for my taxes and my insurance. And so now I'm working even harder at my 9 to 5 than I did. And I'm working hard to manage these properties. But all of a sudden, this like dream that you have is becoming a nightmare. And so, you know, cautionary tale number one for your listeners is buy, absorb, right? And then buy some more. Like, don't just keep buying if you can't manage the assets. Or number two is go find a professional management company that will take your properties. My problem was my properties were so low, I couldn't get a professional management company to take my properties because
Really?
the management companies know how hard they are. And I'm like, well, I'm going to give you
Wow.
25. They're like, yeah, great, keep it. Like, we want to charge you more. So I ended up creating the management company with Steve so we can manage our own properties. And so there's two things, the two big instances that happen in my investing life that has propelled me to pay off properties, right? So let's get to your question. The first thing was I bought all those properties and I wasn't making cash flow, right? But I had to pay the note every month, right? And at the end of the year, now I'm getting hit in tax and insurance. And so there was no cash flow there and there's no appreciation. I just told you it took them 25 years to get that double or triple of appreciation. So I
Right.
owned these properties for 10, 12 years for 35,000 and they were worth like 45,000, right? 50,000. I told you I got equity, but that nothing ever increased. So when the banks are coming and asking for their money and I got to go work a double because I need more money or I got to go sell off stock because I got to, so that was something that kind of made me realize maybe I want to be the bank myself or maybe I don't want to owe the bank so much money. So that was the first thing. The second thing was I ended up buying that 100-unit apartment complex that I told you about. And that 100-unit apartment complex, I am still today friends with the lead investor. He's a good guy. We just had a bad plan. We lost the apartment complex. Now, I was a passive investor. And now here's cautionary tale number two for your investor listeners. If you're going to be a passive investor, make sure that you either A, have an attorney you trust, or B, read the documents yourself. So I was a passive investor, but I was legally on the hook with my credit. So I personally signed the note. Yeah, I see. I see. If
Oh.
you, for those of you not look, for those of you listening and not watching the video, Michael's jaw just dropped 3 feet, right? And then what happened was because the plan was bad, we couldn't make a payment, and so the bank led us to believe that we can restructure our debt. Well, they ended up having somebody that would buy the property from under us. So they foreclosed on us and sold the property for more than what we owed, which in normal cases you think that's fine. I owed 1.1 million, they sold it for 1.5 million. I should be off the hook. Well, there was a little checkbox that said, no, if they foreclose on me, regardless how much they sell, they can sue me for that amount. So I got personally sued for $1.2 million.
Oh my God.
All because now I will tell you this, I paid a mentor and I paid an attorney before I got into that deal, thinking I've covered myself. I got a guy who's done a bunch of apartment complexes. I have an attorney. They just missed everything. They just missed it. The mentor wanted the deal to get done because he was the broker on the deal. So it really was, it wasn't aligned. of course, at the time I was like, get the deal done, but he needed to protect me from myself at that time. And so so long story short, I ended up selling I had a 6 unit apartment complex that I sold, made 30 grand. And I actually was able to pay $30,000 to make the lawsuit go away. So the bank knew that what they were coming after me. They knew that they didn't really have a good case because they made their money. So they just wanted their attorney fees paid for. But that put the fear of God in me, to be quite honest. And so I
bet.
vowed that I don't want to ever be over leveraged. Right. And so, of course, Kiyosaki talks about other people's money, and every, rich guru, rich dad, poor dad guy, every guru out there will tell you if you can borrow 110%, borrow 110%. Well, back in the early 2000s, you were able to borrow 110%. I don't know if you remember. And so
Yeah.
I did that. Right now, I was fortunate that I was able to overcome when the properties weren't making any money because I had a job. But if you are, again, cautionary tale number 3, if you are a full-time real estate investor, you cannot survive when you're cash flow negative. It's very, very difficult, and you have to sell off assets. But if the assets are worth less than what you owe, that's a challenge.
Yeah.
So when I got into property management, I realized pretty quickly that people will manage Class B homes. People will buy and rent Class B homes. I had this mindset that people will only manage or rent Class C or D homes. I'm like, no one's going to pay $800 in rent or $1,200 in rent. I can go buy a nice property, and have $1,200 in my mortgage, right? Like, it was a mindset thing. And so another tale is, if you're an investor, don't try to buy anything that you would live in. Other people will live in stuff that you're like, why would they rent stuff when they can buy something? So when I found that aha moment, I pivoted, and I hired a property manager finally. Like, I was trying to property manage, and I was terrible at it. I had to hire a property manager. First day she comes in, she goes, okay, we're going to fire half your clients. This is a true story. We had 67 doors, 30 of them were mine. She's like, we're going to fire half your clients because those houses are in the low income area. They're not worth managing. We're going to pivot. We're going to get these Class B homes. Oh, and by the way, you need to sell off your homes. We're not managing your homes either. So, you know what? I said, you know what? I've been trying to make this work for so many years, and every year I'm coming at the end of the year, I got to pay money. Now I quit my job to start my property management firm, which, by the way, I was making $105,000 a year. Now I'm making $12,000 a year. And I'm like, okay, these properties, they can't be an albatross around my neck. So I sold a bunch of them. So I had, I think, 31 of them, and 25 were in kind of the lower income area. And I couldn't get rid of some of them, so I owner financed them. And that was when I had this aha moment. So I was able to wrap the note. I had I had a local bank, and I had a very good relationship with the local bank, and they allowed me to wrap the note. Right. So basically what that means is I've sold the property to you, Michael, right? But I still own the property. You pay me 10%, 20% down. You're going to pay me a mortgage, and then I'm going to pay the bank the mortgage, and I get the spread.
Yeah.
It
Yeah.
was the first time ever that those properties made me money.
Wow. Okay. And
First time ever.
were you able to sell them for much more than you paid for them? I know you said there wasn't much appreciation.
No appreciation, but remember, I did have equity, so I sold them for like 50,000,
Okay.
50 to 55,000. I bought them for 35,000, so I was able to make money that way. But if you think about it, I had lost so much by owning them, by doing the rehabs, that I kind of broke even.
Okay.
It's great. Look, I'm able to be on podcast now and tell that story, I guess. It's
Right.
it's a school of hard knocks, right?
That's it.
So, hey, college is way more expensive than that, by the way. That just took me a lot of time. I ended up breaking even and making a little bit of money on it. But what happened was, so when I started my property management firm, I don't know if you've ever started a business from scratch, Michael, but it is not easy, right? I didn't build it. I didn't buy somebody else's business, right? I built it from scratch.
Hmm.
And it's 80, 90-hour weeks. It's every day, and so I got away from the investing thing. So I sold off my assets. I had a 52 unit that I sold off as well, took a bath in there. Investors lost the money. So, like, I don't like multifamily. I can just tell you that much. I know you do. I've listened to some of your stuff,
Yeah.
but we could debate that on another podcast, right? We're going to
That'd be a
debate
lot of
why I
fun.
pay things off. So when my property management firm 7 years later started becoming like I was working now 5 hours a week, 10 hours a week. I started getting back into buying investment properties. So I was able to find and I bought a couple of properties for about $120,000. It's called Baytown. It's a little bit. It's like a Class B, B minus area, blue collar. I like it. Great area town in Houston to buy in because there's a lot of renters there. But I started buying them, and I started buying them cash. So of course you have to have the cash, right? So I had some cash. So I was able to buy in cash. Um, and so on my other properties that I did keep, I kept paying those down and I had those in cash. So today, instead of 31 non-producing properties, I have 8 properties. One of them is paid for and I own the note. So I sold it. I did an owner finance sell. And I make more money on that property now than I ever did when I rented it out. I have 3 others that are paid for, 4 others that are paid for, and then I have 4 others that have a note on them.
Okay.
With the 4 that I bought, the last 4 I bought with a note. It was, one of those commercial loans, package note. I had to put 30% down. I did. I bought them in January of 2020, so right before the pandemic. I bought him for $535 from a California investor. He was done. I got him because I own the management company. So before it went on the market, I made him an offer, and so I got him for $535. They appraised at $640, and I put 30% down, and they cash flow beautifully. And I have a small note, and now if I wanted to sell one of the houses, I can take it out of the note, sell it, pay the note down. So now I own 8 or 9 properties total, and they're worth, close to, I want to say like one, let's call it 1.2 million. I only own 300,000 or 350 on the whole thing, right? And my cash flow is about 12,000 a month.
Amazing.
A little bit less, maybe like 10.5 around there. And so I'm a big fan of owning the property outright. So I have a bunch of houses that are paid for, right? So just hear me out on this. I am now in my 50s. So in my 30s, I was a big fan of taking out mortgages as much as you can, buying as much as you can, because you have this thing called time on your side.
Right.
You can make mistakes, right? At 50, you have less time, right? I have 20 years less. So I can't really make the same mistakes. So I believe, even though I make less cash on cash, right? Less overall, I have this thing where I can sleep better at night. Like the house is paid for. Like, for example, I own one house. I just had to put in a brand new AC and heater, right? It cost me I think like $6,000. That's cash flow for a year in most instances, right? And you can't afford it because you don't have the money. Well, when the house is rented for $2,500 a month, that's only 2 to 3 months. It's not terrible. It doesn't knock you out of the game. You're not always stressed for cash. In my bank account for my business, my housing business, I got like $35,000 to $45,000 sitting there all the time, right? So if anything ever happens, I'm okay.
Yeah.
And so and now because they're paid for, I have more cash flow. I don't have to pay all the notes all the time. So again, as you get older, you're like, okay, well, how can I afford to live day to day? Well, if I have $12,000 a month coming in and I only have $22,000 of going out for principal and interest, well, now I'm at 10 grand, and now you figure another 3,000 a month in taxes and insurance. So now I'm at 7 grand. Well, that's almost 80,000 a year in Texas. It's not terrible. And of course, if maintenance happens, which always does, you never get that full 70%, right? You never get that full deal. So because of my past issues with banks, by the way, the bank on the 100-unit apartment complex they really screwed us. They led us to believe one thing and kind of did the end around. And so because of that, I'm really, I was scared is not the right word, but very resistant, very hesitant to do it. Now, that doesn't mean that I won't take on a note, especially if I can't afford to buy something in cash, but I'm always going to put 20, 30, 40% down, whatever the bank wants, and then a little bit more. And then I'm at the back end of my life, right? So I am looking to pay these things off. So I have 20-year amortizations. If I could pay them off in 15 years, okay, I'm 60, 65, and now I have no notes and I have all these houses paid for. And at the end of the day, you want to live on cash flow, right? You don't want to live on like hoping that your properties increase in value and then you can take the money out. If they're paid for, in 10 years, I can go take, 80% of the value of the house, which are increasing now, tax free. So so I do have ability to go take the money out should I choose to do that.
Yeah. Man, Pete, this is wild, man. This is such a cool story. And of course, I'm so sorry to hear that you had to deal with all that nonsense BS, but it sounds like it helped lead you to the decision and kind of path of where you are today. So would you say that you're thankful for those experiences, as crummy as they were?
Yeah, look, whatever doesn't kill you makes you stronger. And I think I'm a better business partner today than I was back then. I'm a better investor today for sure. And so overall, I feel like I'm better. I'm a better as a person because when like I said, if it doesn't kill you, the one thing that you as an investor, as a real estate investor, you have to make sure that you don't make the mistake that could put you out of business. Right. So when I had the 100-unit apartment complex, I used my 401k, no, my IRA money. So I went and did a self-directed IRA, and that's how I invested my money. Lost it all, by the way. Okay. Again, at 31, I lost 120 grand, which is a lot of money for me back then. A lot of money for
Yeah.
anybody right now. Okay. But it didn't put me out of business. Once I was able to clear my name with the bank, my credit was cleared. Everything was clear. Like it's not on my credit
Okay.
history at all because they know they messed up, and that was part of our deal. So that allowed me to get back in the game and buy. I had another pair of business partners that they ended up taking bad advice. They ended up using credit cards, taking money out of their credit cards, cash advances to put money down to buy this apartment complex because some guru told them that he did it. Just because he did it and it's possible doesn't mean it's the right thing to do. Well, they had to declare bankruptcy. So they were out of the game. You have a bankruptcy, you're not going to be buying investment properties, let alone, you're not even going to buy your personal home, let alone investment
Right.
properties. So as a real estate investor, if you're listening to this, it's great to take on some risk. I mean, obviously we all take on some risk, right? We don't, there's no guarantee price is going to go up. There's no guarantee that people are going to pay their rent. There's no guarantee, but don't take on a risk that will put you out of business.
Yeah, I love that. And I think that makes
You
a
know?
ton of sense. Pete, you said something kind of at the beginning of your story that I want to come back to, and that's you were buying these low income properties, and you bought them and you scrimped and you saved and you put these deals together, and they really hadn't appreciated very much. And you sold them because your property
And
manager
then
told
they
you like,
appreciated.
thou shall. Right. Yeah. And then after the fact, they appreciate it. So like, talk to us about how people should be thinking about if they're in a similar situation. They bought a property, they did all this work to get the deal done, they scrimped and they saved, and they just haven't seen very much appreciation. Maybe they're in a similar situation where it's not cash flowing or it's just covering its expenses. It's just not what they thought it was going to be. When should someone cut their losses and run and maybe go try something else? Or how do they know maybe they should keep hanging on because we're right around the corner from that appreciation jump?
Yeah, that is. If I had a crystal ball, I could answer that. I can just tell you. I can just tell you from my perspective. I did everything I could to make those properties work. I mean, I would put it. Like when we did a rehab, we made the house even nicer than it was. Right? We got rents up, but for whatever reason, man, we just could never get them to cash flow. And we were losing money. After about 5 years, I think you got to cut. I think if you do not have the cash flow where you can lose money every year on your properties and it hurts you, I think you got to cut the cord after a couple of years of trying everything. You have to try everything though. I'll tell you, my
Yeah.
grandfather, before he passed away, he was in his 80s, and when he passed away, he was worth, I think, 30 million. So this is a guy who knows
Wow.
a thing or two. But he told me, one of the last conversations I had with him, he said, Peter, never sell your property. When grandpa died, we had a lot of property. It was a mess. The guy didn't put any money into it, son of a gun, and we had to deal with it. But it was luckily all those properties appraised in value over time. Time heals all wounds. If you can afford it, and knowing like, hey, like I could tell you this: when I bought the properties in my early 30s, I needed the cash flow as a means to like try to exit out of my my W-2 life.
Right.
Luckily, my W-2 allowed me to handle those properties, right? Allow me to handle the losses. When I got into starting my own business, I knew the upside of starting my own business was great. But starting my own business meant I had to take a huge step back in how much money that I can afford, that I was going to be able to extract out of the business. I wasn't venture backed, none of that stuff, right? I mean, I literally just hung a shingle and I started working. Well, I couldn't afford to lose the money on those properties anymore. So that was a big reason on why I decided to sell. Now I will tell you, I sold all those properties in 2015. I bought them in like 2005. I bought most of them and I sold them 10 years later. So it wasn't from a lack of trying, Michael. Like I tried, right? Even after 2015, they didn't jump up until recently. Like this pandemic has me all jacked up. I have no idea what's up, what's down. I thought for sure all the prices were going to come down. So I sold my last property in that area of town for 120. I bought that piece of property for 50 in 2005. Okay. So here we are. So it kind of matches up, right? 2005, here we are 15 years later. And the thing actually, more than doubled. Now that property I owner financed. I sold it at 120. It was probably worth 100. All right. So probably doubled in value over those 15 years. I always sell it for a little bit higher because I'm holding a note. I want to build in that appreciation. You want to go through the numbers on it real quick?
Yeah, let's do it, man.
All right. So when I owned the home and I rented it out, I was renting it for $1,000 a month. Okay.
You bought it for 50, renting for 1,000. So crushing the 2% rule. Everyone on paper is like, oh, you're killing it.
Right, exactly, on paper, right? So $1,000 a month. So now you're like, Pete, you're making $1,000 a month. But am I, Michael? I'm not making $1,000 a month, right? What do we have? We have taxes, $300 a month. Now I'm making $700 a month. What do we have? We have insurance. $120 a month. Okay, so now I'm down to $580. My management fee was $80. I'm down to $500 a month, and that's before you get into maintenance and turn, right? So on my best month, I make $500 a month.
Oh no.
Do you want to go through the numbers?
Yeah, let's do it, man.
Let's go through the numbers. Okay. So I'm renting that property for $1,000 a month, right? I bought it for 50, rented it for $1,000 a month.
Okay, right.
So am I making $1,000 a month?
No way.
No, right? Because the taxes were $300 a month. So now I'm making $700, right? My insurance is $120 a month. So now I'm making $580, and my management fees were $80 a month. So I'm making $500 a month. And that's before any kind of maintenance happens or turn. So the best I can do is $500 a month, right? Okay. So now I sold the property. I sold it for $120, got 10% down. So the note's $113. I sold it on a 20-year amortization, 7%. I found a company that will actually service the note for $30 a month that I pushed onto the buyer. So right now it's costing me nothing. The principal and interest on that house is $778. And it's like, I think it's like $67 is principal and $700 and something is interest. And that's what I make on that house every month, right? If taxes go up, does it affect me and my cash flow?
No.
Insurance goes up, doesn't affect my cash flow.
Doesn't matter.
Refrigerator breaks, doesn't affect my cash flow.
Vacancy could be vacant, doesn't affect your cash flow.
Doesn't affect my cash flow. Now I ended up selling this one to an owner occupied. So I didn't sell it to an investor on this one. So the owner occupied and he pays, and all I got to worry about is if he doesn't make his payment, I can foreclose on him. Don't know what the laws are in California. In Texas, it's about 21 days before we can start the process.
Before you can start the process. Okay.
Yeah.
So
21 days. Well, back in the day, it used to be 21 days to get them out. Now it's like.
That's what I was going to ask. Yeah. Okay. Yeah. So just real quickly on owner financing, because I think this is something that a lot of our listeners who own property should, hopefully their ears are perking up. How do you underwrite a buyer, someone who's going to be, seller financing from you as the lender, as the owner?
So I don't really care about credit at that point. Because if they had good credit, they're not buying.
They go to a bank.
Financing. Right, exactly. So what I'm looking for, and what I'm always looking for, is why is their credit bad? Right. So are they not paying their rent, or are they not paying the electric bill or whatever, car bill or whatever it is. Right. So I want to know why they have such bad debt. I don't care why they have such bad credit. I don't care to have bad credit. And then I'm looking at cash, how much money they make. So what happens is a lot of these guys, so a guy that bought my property, he's in like their construction business. right? So he has his like own little deal. He just shows no income, but he showed me his bank statements and he showed me his deposits for the last couple of years. And so I just look at how much cash do you have? Can you afford it, right? And then as a property manager, I always go to 2.5 to 3 times. So if I can get 2.5 to 3 times of cash for what it's going to cost him all in, then I feel at that point it's not that big a deal. Also, he's paying me 10% down. So I have some cash there. So if he did move out or couldn't afford it anymore, I got a little bit of cash. I could make the place a little bit nicer.
Okay.
But the mentality of somebody who buys your property, even if it's owner finance, versus somebody who rents your property, let me just tell you what happens, right? When somebody used to rent that property, what they used to do, they'd give me a long list of stuff that didn't work in the house that they wanted me to fix it, right? Even though the lease says as is, all that good stuff, right? When somebody buys the house, they're getting a long list and they're improving the house. When somebody rents your house, they're paying the car, they're paying the electric, they're paying their damn Hulu bill before they pay you. Because they know that they know the eviction process all the way through and how long it take them, right? When they own the house, what are they paying first and foremost?
They're paying that mortgage first every time.
They pay the mortgage first. Hulu gets put on the back burner. The car payment gets put on the back burner. So the mentality is completely different. I've only, I think he's been over there a little over a year. Never had one issue with payment. Knock on wood.
That's great. And is the note, are you going to full term to 20 years or is it a couple shorter year term with a 20-year AM?
I will have to double check, but I'm pretty sure it's just a 20-year amortization and he just pays me to 20 years and then that's it.
Okay.
So what a lot of people say to me is, well, Pete, you're missing out on the appreciation, right? Like if you sold the house for 100 or the house was worth 100 and in 20 years it's gonna be worth 200, right? So if you think about this, Michael, most people don't pay extra. Most people don't pay the house off early. Or if they do, right, great. They pay the house off early and I make my money. But he's paying $60 in principal and $680 in interest.
Right.
If he paid that house off in 20 years, he's going to pay about $240,000 on that house. I think I got my appreciation.
Yeah, I think you're doing just fine. Yeah.
I think I'm good.
Oh man. I love it. That is so cool, Pete. That is so cool. You've got such an interesting story.
I built the cushion of the 20,000 so that he can't refinance right away. Right? Because the house is only worth 100. So by selling at 120, no one's going to give him $110,000 or whatever it takes to refinance the house. So by increasing it a little bit, you save yourself at least those first, 5 years or so.
Super, super smart. Super smart.
Yeah, that's a good one.
That's a really good one. That's a really good one. Man, Pete, we could chat for hours, man. What's the best way if people want to learn more about you, reach out to you I know we didn't get to cover your VPM solutions today, but learn more about you. Where's the best place for them to do so? Yeah,
best thing is they can actually I'm on all the socials, I guess, but it's Pete Neubig, Neubig, and you can email me at pete@vpmsolutions.com, or you can just go to our website too, vpmsolutions.com, and check us out.
Right on, man. Well, thanks again for coming on and sharing some wisdom. Really appreciate you.
Thanks, Michael. Appreciate talking to you.
All right, everyone, that was our episode. A big thank you to Pete for coming on. Super interesting way of thinking and doing things just a little bit differently than maybe we hear about what we need to be doing as investors. So as always, if you've liked the episode, would love to hear from you. Ratings and feedback are always appreciated, and we look forward to seeing you in the next one. Happy investing.